Did you have quantum computing threats on your crypto bingo card for the week of July 27, 2026? Because I definitely did not. Welcome to today's deep dive.
Yeah, it's definitely a wild start to the week.
Right. So today we're unpacking the latest Vantage Plus weekly crypto outlook. And our mission here is to really figure out if we are looking at, a temporary market cool down or maybe a permanent fracturing of the crypto space where only the biggest coins survive.
Exactly. I mean, the broader market forces are absolutely pulling the strings right now. The report points out that negative equity sentiment, specifically the Nasdaq, is acting as a massive headwind.
Okay, so the Nasdaq is kind of our macro weather vane here.
But yeah, when traditional tech stocks stumble, institutional investors immediately start de-risking their portfolios, which basically means dumping highly volatile assets like crypto just to shore up cash.
Got it. But this is where the Vantage Plus report gets, like, slightly sci-fi.
Oh, the quantum computing stuff, yeah.
Yeah. At the exact same time, traditional markets are pulling crypto down. You have heavyweights like BlackRock, Fidelity, MicroStrategy, Coinbase, and Galaxy pooling $15 million together.
Wow.
And they are funding open source development specifically to protect the Bitcoin network from future quantum computer attacks.
Which, tells us a lot about the underlying mechanics of the market right now. I mean, quantum computers theoretically have the processing power to just brute force the cryptographic keys that keep blockchain secure.
That sounds completely terrifying for the market.
It is. But by preemptively financing post-quantum cryptography for Bitcoin Core, these financial giants aren't just doing a neat tech upgrade, they are laying down institutional armor.
Institutional armor, I like that.
Yeah, this kind of preemptive defense creates a psychological floor for investors. It signals that the biggest players just won't let the network fail.
Which mechanically prevents panic sell-offs during those NASDAQ-driven downturns you mentioned earlier.
Exactly.
So let's test that institutional armor against the actual charts. Right now, Bitcoin is sitting at $64,386. It's stuck in this sideways pattern after failing to break this $65,000 resistance ceiling.
Yeah, and the report highlights a pretty massive contradiction here. The weekly chart points to a downward trend, yet the daily chart is actually bullish.
Because Bitcoin has stayed above its 50-day moving average since July 14th, right?
Great.
Wait, but if the longer-term weekly trend is pointing down, why should anyone care about the daily chart? Isn't the longer time frame always more reliable?
Usually, yes. You would absolutely trust the longer time frame.
Yeah.
But you have to look at what that 50-day moving average actually represents in today's algorithmic trading environment.
Meaning the trading bots are kind of running the show.
Basically, yeah. It's not just a line on a graph, it's a mechanical firewall. Institutional buying algorithms are often programmed to trigger purchases right at that 50-day average.
Oh, that makes sense.
So as long as Bitcoin holds that ground, those automated buy orders just absorb the selling pressure. That allows the daily momentum to just override the weekly pessimism.
And Ethereum is clearly benefiting from that same institutional halo effect.
Oh, absolutely.
Right. ETH is trading at $1,880, and its monthly chart has actually reclaimed earlier losses.
Yeah, the report suggests that if it holds its rising trend line, $2,000 is totally in reach.
Though dropping below $1,600 is kind of the trapdoor to serious downside. But, here is where the market completely fractures.
The altcoins.
Right. While Bitcoin and Ethereum have that institutional safety net, the rest of the altcoin market is just getting crushed.
The divergence is really stark. I mean, we are no longer in an everything goes up together market cycle. Capital is rotating out of riskier altcoins and fleeing to the perceived safety of Bitcoin and Ethereum.
Just look at XRP. It's trading at $1.0951, and it has zero of Ethereum's positive momentum.
Yeah, for XRP, its 50-day moving average is acting like a really heavy backpack. Every time the price inches up, algorithmic traders use that average as a trigger to automatically sell, just constantly pushing XRP back underwater.
And if that automated selling pressure pushes XRP below parity, meaning that psychological barrier of exactly $1 things get super dangerous.
Extremely dangerous. In crypto, breaking below a round number parity often triggers retail panic selling. And the report shows XRP could plummet all the way down to $0.537 if that $1 floor gives out.
Man, that's brutal. And Solana isn't looking much better. SOL is sitting at $74.71, and the charts are just showing these tiny little candlesticks. It's barely moving.
Those tiny candlesticks actually represent total market exhaustion. Liquidity is completely drying up in the altcoin space.
Wow.
Buyers aren't stepping in, and sellers are just waiting for a trigger. For Solana, that trigger is a break above $82 to show signs of life, or a drop below $63 for a fresh downtrend.
But mechanically, without the institutional backing we see in Bitcoin, SOL looks highly vulnerable to profit-taking right now.
Very much so.
Okay, so for you managing your own portfolio, here is the playbook. Keep a close eye on the NASDAQ to gauge macro risk.
Yep, crucial.
Watch if Bitcoin's algorithmic firewall holds at that 50-day average, and monitor XRP to see if it triggers a panic sell below that $1 trapdoor.
And pay attention to where the smart money is building moats. The capital rotation toward institutional safety is really the defining narrative of this week.
Which leaves me with one final thought for you to ponder. If major financial institutions are already pooling millions to build a quantum shield around Bitcoin, how long until those same quantum leaps threaten to rewrite the encryption, keeping every other digital asset in your portfolio safe?